Hi, I'm Matty Loans. Welcome to Buy, Borrow, Build. The term home ownership, is that the American dream or worst nightmare? The fundamental need for housing, whether renting or owning, has become nothing other than unaffordable. And since the pandemic, housing's turned from a necessity into a luxury. Even the term affordable housing is much of an oxymoron. And perhaps it's just better to define it by what it's not: unaffordable. From a loan originator's perspective, we qualify an affordable home through a 28/36 ratio, known in the business as the front and back end ratio. And these numbers signify max allowances for your monthly housing and total debt respective to your gross monthly income. Now, why? Well, studies show that these ratios provide long-term success for the repayment of the loan. And keeping within your budget, those limitations is a greater challenge today than it's ever been. And higher debt service ratios are the number one reason for a mortgage decline today. However, the U.S. Department of Housing and Urban Development defines affordable housing as a household where the occupant's paying no more than 30% of their gross income on housing. But that includes utilities. It's a comparable number to the front-end ratio of debt to income, but in a rent equivalent. And by limiting the housing expense to 30%, it allows the occupant the ability to afford other expenses, food, transportation, medical, and perhaps even save some. And if you're spending more than 30% of your income on housing, you could be tipping the scales on affordability. The problem with the HUD definition is that all real estate's local. Housing costs vary by geography, and where you live dictates your earning potential. Therefore, the definition of what makes housing affordable has got a lot of gray area. And while some may want to give up on hope, others want to understand the root cause on the affordability crisis. Clearly, that's easy to shake a finger at it, but today, this video hopes to put a finger on it. And here are 5 reasons contributing to the housing affordability crisis, and identify which one deserves the bird. Last week, the Case-Shiller 20-city home price index rose 4.5% year over year, and that figure was below expectation, indicating slightly cooler prices. Limited housing stock continues to support price growth as home prices remain elevated across the United States. And the frenzy from the pandemic's past, but prices remain high, not because of higher demand, but because of limited supply. Resale inventory rests around 4 months supply, while new home inventory is at about 9 months. Home building is still extremely profitable, just not as profitable as it's been during the pandemic. And home builders are still moving inventory through interest rate buydowns and incentives that have capped the amount of units to about 500,000, which is flat over the last 6 months. Even with a surge of new home construction, many economists declare the U.S. housing markets at a deficit of 4 million homes. Short supply is one of the biggest challenges impacting affordability. Resale inventory is rising to or past the pre-pandemic levels, but nearly half of all mortgages outstanding are locked in at 3.5%. And many of those potential sellers couldn't qualify to make a lateral move, even if they wanted to. With the number of new homes built plummeting since the great financial crisis, the aftermath of Dodd-Frank, and the imposed limitations on the financial sector, it's a different world today. The mortgage industry is more concentrated and home programs are limited, reducing the opportunity to finance a home. Further, zoning and land use regulations have also increased steadily since the mid-20th century. And further, the not in my backyard cohort is complicating the process for increasing the housing supply. So if there's low supply, let's just increase the supply, make builders build more homes, and problem solved. Last year, home completions reached the highest levels in nearly 2 decades, finally surpassing the rate of new household formations for the first time since 2016. Housing still feels the impact of the Great Recession, when building was limited for an extended period of time. Production costs have increased for builders likewise, forcing many production builders to focus on chunk pricing by building condos and townhomes, properties with attached and shared walls, to remain profitable. Now, if this deficit of 4 million homes is true, this is a problem that could take decades. The high prices of homes today is a widely acknowledged factor, and over the past 50 years, home prices have risen significantly, so it's only reasonable to expect this trend to continue, right? Like any asset, home prices are influenced by economic conditions that can either depress or boost their value. The 2020s are set to experience the most substantial increase in home prices seen in 5 decades. In the 1970s, home prices rose by 43%, which pales in comparison to the growth of the 1980s when it was under 10%. Now, the growth persisted through the 90s and peaked during the Great Financial Crisis, following the largest decline in home prices seen since the Great Depression. And even in the strongest housing markets, prices dropped by low double digits. In some of the hardest hit areas, like Phoenix, home prices fell by nearly 50%. Since 2020, home prices in Phoenix have risen by over 50%, making it challenging to determine a fair price in 2025. Buying a home is a choice, and if the financials don't add up, renting is always an alternative. Purchasing at current market prices isn't affordable when you combine these prices with interest rates between 6 and 7%. And from the seller's perspective, considering all those 3.5% fixed rate mortgages, do you really blame them? Many potential sellers in this market couldn't afford to sell and make a lateral move even if they wanted to. On top of it, approximately 40% of all the homes in the United States are mortgage free, creating less urgency to sell. Now, increasing your income by 10% per year is very difficult, yet unfortunately, that's the rate of home price increases in many markets. In the mid 1960s, the average home price was $18,925, while the median income stood at $6,569. From 1964 to 2022, home prices increased at twice the rate of wages, according to the U.S. Census data. Renting might currently be the best option, and by renting for less than it costs to own, one can hopefully pocket the difference, thus increasing the potential for higher down payment when that opportunity arises. Justifying the current cost of housing, modern homes are significantly more advanced than those 75 years ago. Features such as plumbing, central air conditioning, LED lighting, and construction materials like granite countertops make homes more expensive today than in the past. These amenities are present in 90% of homes today, and Americans, they're willing to pay for them. They offer a higher quality of life and more property, making it more attractive than urban living. In the 1950s, 64% of Americans lived in urban areas, while today, that figure exceeds 80%. The main issue with the wait and rent strategy is the expense of renting. Even though nominal incomes have increased, living costs can consume 50% or more of a household's income. This is largely due to expenses beyond housing, healthcare, education, and a consumer culture that values convenience and immediacy over savings, thus puts more pressure on wages. The positive aspect is that income has increased. The downside remains it hasn't risen sufficiently. According to that same 2022 census study, the median household income reached $74,580, which is over 10 times higher than what it was in 1964. However, home prices have grown to $432,950, which is 20 times the 1964 amounts. Check out the stats. Income to home prices in 1964, 34%. Income to home prices in 2020, 17%. The area median income represents the median point in which the income distribution of a particular area is determined annually by the Department of Housing and Urban Development. This means that half of the area's earners have incomes below this number, while the other half have incomes above it. The AMI varies by region and serves as a barometer for determining eligibility for affordable housing. Housing prices are not the lone culprit. Taxes, insurance costs, and maintenance also have risen dramatically over the past 5 years. Now, what income level is necessary to buy a home in this market? According to the New York Post, the median home price for April 2025 is $431,250. Now, to qualify, you need an annual income of at least $114,000, assuming 20% down payment and a 30% front-end ratio. If you can't raise your down payment or lower your purchase price, you'll need to boost your income. Look closer at a stark divergence of income to housing prices that began around 2000. And from 2000 to 2008, housing prices rose by 4.2% each year. And from 2008 to 2023, they increased by 4.4% annually. Meanwhile, median family income grew at a much slower clip, 2.5% annually from 2000 to 2008, and 3.4% from 2008 to 2023. Last year, the 30-year fixed rate averaged 6.72%. Now, boomers are happy to remind everyone that when they purchased their first home in 1982, rates were 14%. Meanwhile, millennials will tell you anything over 5% is highway robbery. Both viewpoints have merit, but it's important to consider what interest rates look like before the 1970s. And before that period, back to the Great Depression, rates averaged between 4 and 6%, with some periods actually going below 3%. The average annual mortgage rate over the past 95 years is 6.71%. Considering historical data, it's reasonable to conclude that today's interest rates are fairly priced. In recent years, interest rates have been even higher, 8% or more. So, what are the odds that rates will increase further given that inflation poses a significant threat? Now, certainly that's a possibility, but consider all of the following. In the short term, market volatility has spiked due to the Trump administration's proposed tariffs. The uncertainty for the future prices of many goods and services may impact earnings and profitability. The longer the volatility remains, that just increases the flow into bonds, and the shakeup should create an opportunity for lower interest rates, especially mortgages. In the near term, consider the Fed's short-term monetary policy, and if you've listened to the Fed pressers, Chairman Powell has reiterated the commitment to the 2% target rate. 2% represents the annual inflation rate. Inflation has cooled tremendously over the past 4 years due to the increase in interest rates, quantitative tightening, resulting in demand destruction. Simply put, it's harder to afford a home post-pandemic than pre-pandemic, partly due to the interest expense on a mortgage. It's going to take time, but the Fed's adamant about restoring the 2% target rate. Longer term, consider the demographics of the aging population. Through the next few years, the U.S. will have over 11,000 people daily retire. That's a tremendous amount of people that are leaving the workforce and reducing consumption. They're buying less homes, less cars, in general, everything. Further, the onset of artificial intelligence is set to disrupt the economy in a major way. It'll reduce the prices of goods and services across the board and likely increase productivity. Like tariffs, it's hard to estimate the impact of AI and what it means to jobs and economic output. When you combine all these factors, rising interest rates may be the least of your worries. This is going to sound crazy, but inflation isn't inherently negative. In fact, some inflation is beneficial, indicating that people are spending money and the economy is expanding. This is desirable as deflation poses a greater threat, a contracting economy. Inflation refers to the rate at which the prices of goods and services rise over time. It can impact nearly any product or service, including essential costs like housing. The risk of inflation is that once it starts, it can spread throughout the entire economy, fueling expectations of continued inflation, becoming a major concern for consumers and businesses alike. Inflation can arise from several sources, such as rising production costs linked to raw materials or labor, or perhaps disruptions like we saw during the pandemic. Add in higher demand, government spending, tax reductions, and lower interest rates, and there's more inflation. Now, it's a responsibility for the Federal Reserve to keep an eye on inflation. When inflation accelerates too quickly, it can make essential goods unaffordable. Additionally, inflation diminishes consumer purchasing power, reduces the value of currency, and can hinder savings returns. The primary risk of inflation is that it acts as a lagging indicator. Price increases are only noticeable after the economic activities are recorded. Just like the saying goes, where there's smoke, there's fire. Economic activity is the initial sign, while inflation comes afterwards, indicating the outcome of spending. This delayed characteristic of inflation is essentially for comprehending its behavior and function in our economy. Houses are regarded as asset goods, which means that during inflation, house prices will typically rise at the same rate as inflation. And this can become a self fulfilling prophecy as the increase in home prices during times of high inflation makes them more costly to buy. Higher inflation leads to an increase in interest rates, which in turn raises the cost and the price of financing home more than before. The situation worsens the imbalance between housing demand and housing supply. There may not be a single good reason why homes are unaffordable, and likely it's a combination of all the factors mentioned, known as purchasing power. Are home prices really the issue when the real problem is that your dollar loses value over time? Purchasing power is influenced by inflation or deflation, earnings or wages, interest rates, and a few other factors. Purchasing power is determined by the amount of goods or services a unit of money can buy, usually in round figures like $100. Similarly, inflation can lead to the dollar's devaluation. In a consumer driven economy like the United States, saved money becomes less valuable over time. For example, if you save $1,000 at 2% per year, a year later it grows to $1,020. However, if an item's price rises from $1,000 to $1,050 in a year, you've effectively lost $30 in purchasing power. That item simply costs more. Conversely, if home prices decrease, your purchasing power can increase. It can allow you to buy more house for the same amount of money, provided you have the same income. While maintaining purchasing power is mostly beyond your control, there are some strategies you can use to enhance it. You can earn more money, allowing you to afford more home, or relocate to a region with a lower cost of living. Now, during the pandemic, we saw tons of this. Many people leveraged remote work to enhance their purchasing power. Workers from California moved to areas where their incomes could afford larger homes or similar homes for significantly less money. Interest rates have a comparable impact. When interest rates rise, borrowing becomes more expensive, which reduces the potential loan amount. On the other hand, if borrowing costs decrease, you can afford a larger loan, potentially leading to higher home prices. During the pandemic, interest rates remained significantly below long term averages, creating conditions for the lock in effect. I'm curious to your thoughts and if this notion of affordable housing is a misnomer. If it was an issue even before the pandemic, recent discussions have highlighted that it's only worsening. Achieving affordable housing requires two things: time and making wise decisions. Factors like home supply, prices, income, interest rates are mostly beyond your control. Additionally, purchasing power diminishes the longevity of your savings and earnings over time. History's shown that high inflation periods eventually end, offering opportunities for home ownership. Hopefully, by that time, your income will have increased enough to catch up to home prices. If waiting isn't an option, consider finding a new job or starting a business to boost your income. Alternatively, relocating to another state or region to lower your cost of living might offer a solution in your gateway to home ownership. It's all been done before. And remember, it's just a house until you make it a home. Housing needs you in the most affordable way. So, which one deserves the bird? Well, that's up to you. In the meantime, never lose hope. And remember, Maddies, I always got your back.